If the income that you have as an individual in the United Kingdom was represented by an ice cream, and that ice cream was made up of your employment income, your self-employment income, property income whatsoever, pile it all together, one thing that's pretty much guaranteed to take a slice or a big bite out of that ice cream is tax. The good news is, in the UK, you can keep some of that ice cream all for yourself by the use of personal allowances. In this week's video, I'm going to be looking at how personal allowances work, how they impact on your tax obligations, especially when you've got a mixed income stream. So that could be you've got a business from which you're generating profits or building it up. You've also got part-time or full-time income from PAYE as well, to name but two. What happens is, if you don't manage your personal allowances correctly, you can get a nasty shock to the system when you come to your personal tax return. I've seen that too many times, and I don't want that for you. Let's get on with it. Now, the UK personal allowance is the amount of income you can earn each individual tax year, which, thank you to the Church, Julius Caesar, runs between the 6th of April of 1 year and the 5th of April of 1 year, and the allowance for the 24-25 year and up to and including 2028 is 12,570. Any income over that is free of income tax. Now, there are three key rates, which we'll explore in another video, but as a headline, those rates are 20%, up to and including becoming what's called a higher rate taxpayer, 40% when you're a higher rate taxpayer, and then once you get over that magic line, then you pay 45% as additional rate. And that's not all. There's another little trick that's tucked in the HMRC rulebook, and that's when your income, adjusted net income if you want to be posh, goes over 100 grand, for every £2 over that, £1 is clawed back. When you get to 125, 140, say goodbye to your personal allowance completely. Now, just a little note, folks, here, the income between the 100 and 125,000 is effectively taxed at 60%. That's an eye-watering amount. It's called your marginal rate if you want to be posh amongst your friends. Let's get back to some basics as well. Now, if you have got income from PAYE, called pay as you earn, what will happen is your employer will give you a tax code, which is based on your personal allowance. You should have completed what's called a startup form here, and each week on each month that you earn income, that allowance is allocated there. That typically happens as the default position, unless you want to change that. And what that means is when you come to the end of the year and you do your personal tax return, you add in your employed income, you add in any self-employed profits you've got, any property income and anything else you've got, put them all together, and you think, great, the income that I've got outside of PAYE will be tax-free, or largely I won't pay a great deal. And that's going to be, unfortunately, a bit of a shock to the system. Because your allowance has been used up during the course of the year, you'll suddenly find, if you haven't made provision, a big tax bill, and we don't want that. So when you've got multiple income streams, make sure you check out how your personal allowance has been utilised in your job. Remember, that's the thing that the allowance is going to be used for. If you end up paying no tax for your PAYE because the income is not that great, remember though, you've used up that personal allowance there as well. If you haven't used it fully, you can still use the excess, but you won't have that up your sleeve. If you check out last week's video, by the way, one tactic that I was emphasising there was about saving for your tax as you go along. And having that multiple income stream is going to be certainly a factor in deciding how much you put to one side. Now, if we come back to the employment income side of things, your employer has a responsibility to apply that personal allowance through the tax code. Typically, for most people, it's made up of numbers and letters. So on a 12570 personal allowance, the tax code is typically 1257 with the letter L. So various factors will alter that tax code. We've talked about that in previous videos, and I'm going to update that in due course. But effectively, things like benefits that you have, income from other sources, means your tax code notice will change that. Now remember, folks, it's your responsibility to make sure your tax code in your employment is the correct one. It's not your employer's responsibility, strange though it may seem. It's up to you. Always worthwhile, check out your wage slips, check out your pay slips to see what the tax code is. And if it's incorrect, it's either too high or too low, do something about that and have it. Who knows? You may get a bonus by having some tax coming back to you, but that's a topic for another day. Now let's throw some numbers into the mix. Always good when we have numbers to illustrate what's going on. Suppose you have a situation where you got £10,000 from your job, where you get paid wages and salaries, and you get £15,000 worth of self-employed profits. In total, that's £25,000 worth of income. Now, your employer is likely to have used your personal allowance during the course of the year. Let's say it's £12,570. That means it hasn't fully covered the £10,000. You've got a spare £2,570 left over. That will be used against your self-employed income, and then you'll pay the tax accordingly on that income. In terms of tax returns, by the way, figures are put in a big bucket, added together, take off the allowances and apply the rates of tax itself. And again, remember those rates, 20, 40 and 45. National insurance, by the way, is a tax potentially on top of that, but that's a topic that's not within this week's I Hate Numbers video. Now, just a couple of sort of side notes here, by the way, folks, on the 100,000 I mentioned earlier. Now, if there's a way to pick people's pockets for tax, then the government will come up with a way of doing that nice for you. Now, effectively, once you get to the 100,000, that 100,000 limit, anything over that, you start losing your personal allowances. There are things that you can do. That 100,000 represents what's called adjusted net income. So if you've got a pension or you're thinking about that, making pension contributions not only benefits for you in the future, but it also means it reduces the adjusted net income. So pension contributions not only are beneficial in the short term and the long term, but it also has an impact on you preserving some of your personal allowances. Also, if you make gift aid contributions or gift aid donations, that is also taken into account for working out that adjusted net income. And remember, it's when the adjusted net income goes over the 100,000 limit, you start losing out that personal allowance. Now, what are some takeaway tips? Set aside money regularly, especially when you've got mixed income. Here, put that money aside. Talk to your tax advisor, speak to your accountant to work out what that number should be. If you want to explore this conversation even further, check out the show notes at the end and book a slot to have a chat. I digress. Make sure you are fully utilising your allowances. Make sure you're not overpaying. Do check your tax code. It's amazing, by the way, how many hundreds of thousands, not millions of people, do not check their tax code. Remember, it's your responsibility, and an incorrect code could mean you're paying too much tax or too little. When eventually they catch up, you might have a very good positive outcome or a very painful lesson. Understanding how your personal allowances work and how they impact your tax liability is really a vital thing to understand, especially if you've got that mixed income stream. Folks, I hope you found this video useful. I'd love it if your thoughts. Do you have mixed income? Were you aware? Do you check your tax code? I know it might seem like an unnecessary burden, but it's really vital that you do that to stay on top of the complexities of the tax system and making sure you keep as much money that you earn where it belongs. Until next week, happy allowancing.